Hey everyone, it's Imran from Options Insight with your macro options spotlight for today. Remember, for the algo, like,
comment, subscribe, do what you gotta do so this information gets out all over the place.
okay, US and European stocks continuing their weakness, and fears over the consumer are starting to mount, oncoming recession, etc., etc. We have heard it all before, but finally equities are starting to potentially listen to it. China managing to bounce back after a brief pullback that it had, so that was up 2%, but most of the other indices down, and Europe having a bit of a catch-up move, down a couple of percent as well. Precious metals did catch a bid again, so they continue charging on, and oil was also helped by data showing that the highest demand for oil from China in a year. So that's the sort of moving on from that China reopening story. We're starting to see that now coming through in energy markets as well. It was just hitting metals at first, but maybe gives a bit of a tailwind to oil going forward. Still no love for natural gas. That's still down about 10% on the week so far. And then copper also pausing for breath, but that's obviously had an amazing run recently. Volatility wise, European vols did have a bounce because that's really where the movement was. We saw 1.7 sigma moves in Europe, so vols popped about 1.5 to 2 vols, but they still are underneath US indices. You've got 17.5 vol for Euro stocks and DAX versus 19 odd for S&P. Looking at carry, we did see a lot of positive carry before in European indices. That is starting to reduce, but in general, there's a fair amount of green on the board. You can see S&P is quite neutral. We have got Nikkei in minus 35% because that's been moving around quite violently around all this Bank of Japan noise that's been going on. But other than that, generally positive carry in equities. And then the main positive carry coming out in commodities is still in copper and oil. And then skew-wise, we are starting to see skew tick up. So on the week, we've got reasonable moves, right? 1.5 vols-ish in S&P, and even in Europe starting to tick back up a bit. So some demand for skew coming back. I think that's worth monitoring as it may signal a shift in market positioning. If a load of clients do come in and start buying skew, then dealers get taken short those downside puts. If we were to get a sell-off in markets, then dealers would become short vol. That can kind of feed on itself and get markets actually moving again to the downside, and vol may potentially spike. But, I don't think we're quite there yet. You look at the percentiles, we're still in the 20th percentile. So it's got some room to go before the street is structurally in a more fragile position, I believe. And then looking at metal skew, we are seeing gold in negative, silver in negative, and also copper in negative. So all of the metals are pretty much all in call premium on the skew, which is basically pricing in more upside risk than downside right now. Which makes sense given the kind of price action that we've seen so far in metals this year. Okay, if we look at the dollar, kind of stuck at 102 on DXY. Dollar yen's had a bit of a roller coaster, obviously, with the Bank of Japan standing firm, and then US yields have actually fallen more than JGB yields, which is why dollar yen got sold back down again. TLTs and HYG, so the bonds that we track, did drift a little bit lower, but we do feel like TLT is showing a bit of strength here. And we're kind of questioning how far this thing wants to run to the upside, but it does seem like there is a structural bid kind of coming back to treasuries right now. And then finally, ARK was down 3% again, second day in a row. But bear in mind, ARK does trade on a 50 vol. So remember, when you want to work out what the implied vol is actually saying about the expected move of an asset, you just take the implied vol, divide it by 16, and that's roughly what we expect for a daily move, which is pretty much bang in line with the move that we saw in ARK, which is why we've got a 1 sigma down move there. So whilst it looks like a big move, it is your expected daily move in ARK, so nothing to really write home about. Okay, we mentioned the consumer and fears that the consumer is starting to crack. So where are we seeing that? So here you can see we've got those charts showing loan loss provisions from the big banks, JP, Wells Fargo, Citi, and B of A. We did mention that they increased these loss provisions, but it was actually the largest spike in that. If we were to ignore the COVID fiasco, it's the largest spike in about a decade. So a decent uptick there, material uptick. And this is the type of behavior you'd expect banks to have before a recession and an anticipation of spikes in defaults. So they're clearly a little bit concerned about what they're seeing. Now, the main headline that really spooked markets was that Discover Financial Services, DFS, which is a credit card issuer. They forecast that their charge-offs would be double. So you can see here 3.9% versus 1.8 last year. And that took the stock down about 7%, along with its competitors' stocks also getting hit. We do think also the negative wealth effect coming from lower stocks and housing markets, the high credit card debts that we see with quite high credit card interest rates of like 19% plus. We've got a labor market that's starting to show signs of rolling over with the leading data, even though the non-farms data and the initial jobless claims that are considered more lagging are not showing it yet. But we do struggle to see how the consumer spending doesn't come off, and therefore corporate profits, are going to struggle to hold up this year, right? So that's the view. Now the bond market seem to agree in the way that they're trading and this kind of bid coming back for treasuries. Equities still probably need some convincing. We have seen equities obviously selling off a little bit recently, but from my perspective, I wouldn't be surprised to see 4,200 before we see 3,500 on the S&P, right? So as I do think as we approach March FOMC, we could well have a bit of more squeezing out the bears. We've got all the tech earnings kicking off next week. We'll see how they play out. But in general, most investors seem pretty underweight US stocks. So there could still be some more squeezing to be done, in my opinion. And then as we approach March FOMC, which is on the 22nd of March, then Powell's going to need to talk even tougher because the market's been unwilling to believe that they're going to keep rates at 5% all year. And so they're going to have to really say something major to convince markets otherwise. And if they were to do that, then there could be a vicious repricing of stocks later down the line, sometime near that FOMC meeting, after that meeting, or even into the May one, if they don't manage to do it in March. So we do expect more vol later on in the year, but I still think the base case for me is that there's probably some more squeezing to be done, and we may surprise people at how low the VIX wants to go, and it may take out that 18 level to the downside, and we may see levels in the 15 to 16 area before we see a real material move down towards the summer, basically, something like that. And that's kind of how I'm reading it right now. Okay, now if we look at refiners, so refined products are leading the charge in energy. So here we've got a chart showing we've got gasoline and diesel. So since 2 weeks ago, where oil kind of bottomed out, oil's rallied about 8%, but diesel and gasoline are winning that race. They're up a good 5% more than that, around 13, 14%. This is likely due in part to this refiners getting shut down due to poor weather at the end of the year. They haven't recovered yet in terms of refining output. So basically, that's helped. You can see these crack spreads, gasoline and distillate cracks. That's what these red and blue charts are, courtesy of Saxo. These are all like ticking up again as well. And they've kind of held on to those support levels. So sort of double bottoms, triple bottoms type thing. So the trend is still intact for these crack spreads. And these are the reasons why the oil sector, in terms of the stocks, has outperformed the physical commodity so much last year, because these crack spreads determine how much money these refiners make, and that goes into their profits, right? So we do think these stocks are going to continue to do well this year. We also think that, it's a case of it's hard to increase refining capacity. It's a slow process, and it doesn't seem like they're really trying that hard, given the legislation and the Biden administration's incentives for these guys. And then China travel restarting is also going to mean the demand side is more robust. So we continue to think that trend is intact. Clearly, in the short term, anything can happen, but over the more medium term, we like it. So looking at XLE, if you wanted to get long that, right now, the strategy compass is saying stay away. So, given that we are in buy put territory, it's not a no-brainer to buy XLE here. So if you were going to get into XLE, you don't really want to do it with particularly high delta strategies like naked calls, call spreads, or selling puts. If anything, you want to buy puts because the vols come down a bit. Okay, the vols are around 28 right now. Now, realized isn't there. So you can see positive vol carry of about 9. So this thing's not realizing. It's realizing about 20 versus an implied of 28. So it's not a no-brainer to go and bleed a load of theta trying to chase this thing. And then finally, the term structure is quite flat. If we look at the back of the term structure, we've got March here and we've got June here. It's a pretty flat curve between March and June. So the sum of all that says to me that I want to potentially do call calendars. Right. So the trade idea that I'm looking at. All right. That's it for this. That's it for today. It's it for this week. Obviously, look out for our weeklies for subscribers, and we'll catch you all next week. Cheers.